Good afternoon, and welcome to our partner webinar series, The Real Risk, Understanding Your Correlation Risk with Diversifiers, and special thanks to our partner, Aptus Capital Advisors. I wanted to mention a couple of upcoming chapter events. We've got our quarterly meeting on October 19th from 4:30 to 7 with enhanced investment portfolio returns and a networking happy hour. We've got a webinar, Empowering Financial Advisors with AI, Scaling Your Practice for Tomorrow's Markets on November 1st from 12 to 1. And our Member Appreciation and Holiday Social on December 14th from 5 to 7:30. Check our website for details and register now. We are joined today by James Yehudi, Strategic Consulting and Enterprise Relations, and David Wagner, Portfolio Manager, both for Aptus. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to James to begin.
Awesome. Thank you. And thanks everybody for coming out to attend the webinar, and hopefully the recording, if you're not currently on, is valuable. We're hoping to bring some good realistic takeaways for portfolio construction as opposed to just talking markets all day. So hopefully there's a few nuggets and takeaways for you and your clients. First, I'll read a quick disclosure and then we'll get right into it. The opinions expressed during this call are those of Aptus Capital Investment Committee and subject to change without notice. This material is not financial advice or offer selling products. Forward-looking statements are not guaranteed. Aptus reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. More information can be found in our ADV Part 2, which is available upon request. When I said short, I maybe it wasn't truthful there, so sorry about that, but thanks for bearing with me. So a quick intro on Aptus, our firm, and we'll get right into the content just because we're not a household name. Maybe we have been involved with the Georgia FPA for a number of years, so you may have seen one of our sessions or stopped by our booth at the symposium. But we're a group of about 30 folks based in Fairhope, Alabama, overseeing consulting and sub-advising on $5 billion. So in the grand scheme of things, certainly more of a boutique shop. And what we like to call our strategic relationships, what we like to call us, is basically your investment department. So we have a team of 8 CFAs to hopefully be an extension of your team to think through markets, think through portfolio construction, and ultimately be a resource to more or less institutionalize what you've built out for your clients from an investment perspective. We do have individual ETFs and models that are available on a number of the major platforms. We specialize in option-based strategies for both income and risk management. We're not taking huge bets on particular factors or trying to necessarily create alpha through some crazy trend strategy. We're really just looking at tweaking and managing the asset allocation with option-based strategies to hopefully deliver a little bit more consistency for you and your clients. And
hey, James, is there any stock that stands out on that list on that slide today for you?
Good question. Haven't
TXD is on there. They just got bought out by ExxonMobil today. Sorry to cut you out there. We're just pretty excited about that.
Nice. Yep. That's a good one. Hopefully it had a nice pop. And in addition to our portfolios that we offer and individual stock sleeves that we run, we do offer what we call shared CIO services. And so again, back to what I had mentioned earlier, an extension of your team. We have a number of CFAs, marketing folks, CFPs, even an accountant now on staff to really think through your messaging, think through how you're constructing portfolios and communicating, and ultimately try to give give you a little bit more than in your process and your structure when you're creating your portfolios and developing your investment policies. Okay, with that being said, I'll maybe just shift and get into the content today. So when we talk about correlation, risk, and diversifiers, we're going to go through some of the traditional ways that advisors and clients are diversifying portfolios, the good and bad of that, and ultimately some things to consider that may be not traditional when you're talking about your asset allocation. And ultimately, the biggest thing we'll emphasize today is maintaining a structure and just avoiding chasing things. And the past 2 years are really a great example of how chasing performance can really lead to some negative outcomes, to say the least. This is a common concept that is coming up this year, given where rates are. It is just the ability to clip 5-6% in risk-free assets versus investing in stocks, duration heavy assets, credit, whatever it may be. And the concept of that short-term certainty versus your long-term goals is something that I think is maybe one of the biggest challenge that advisors are facing today. Number of clients we hear through the advisors we work with are just asking, why is my 40 of my portfolio down when I can get 5% from a CD? And it's a tough conversation. And in the near term, that may be right, but ultimately we're not investing for 6-12 month returns. We're investing for longer term, farther out goals. And that concept of how you're managing that behavioral risk of selling all equities or moving all to short-term treasuries as opposed to stocks, or even like the ag. It's a tough conversation, and hopefully we'll give you some nuggets to think about and how you can explain the current environment and your approach, and ultimately some good ideas around how you can address this risk, I guess you could call it. And
Yehudi, go back to that slide for a second. Actually, I want to say something, and it's actually a lot of the basis of what of our conversation is going to be here. Like, let's look at that bottom chart there. Short-term certainty. When you have a lot of short-term certainty, it actually leads to not as fruitful long-term returns. And let's put that in context. I think that there was a lot of consensus heading into this year that people were making bets that small was going to beat large. International was going to underperform domestic, a duration call. They had a lot of bets out there, and there's a lot of consensus. And I think a lot of people were betting for value over growth. I mean, the NASDAQ was down 32% last year. Value was down like 5 or 6%, one of the widest spreads we've ever had. And people thought that momentum would continue. And what we saw working with a lot of different advisors is that the conviction that last year's momentum was going to transition also into this year was very, very high. And that's when you look at the top left part of this, the short-term certainty. When that's full, it actually can lead to poor long-term returns. And if you look at that in relative, a lot of the asset allocators who had a lot of this positive certainty, they've been very wrong if you're measuring yourself against, an iShares, a BlackRock iShares allocation, whether it's AOR, AOM, AOK, AOA, they're underperforming. Because if you look at the iShares BlackRock's allocations year-to-date performance versus their peers, versus their allocation peers, they're all in like the top 5% right now. So it's really showing you that even though a lot of people have a lot of conviction heading into this year, one, they end up proving to be wrong, myself in some cases, and that's actually probably hurt some long-term actual return because they had so much conviction.
Yeah, I completely agree with that. And it could kind of coincide with what Dave just mentioned as it relates to the timing and putting certain factors on given market sentiment. But ultimately, if you haven't seen this before, it's something that we we bring up in a number of conversations just because of the risks that you have with moving into treasuries, or just selling off because you're worried about geopolitical risk or whatever the case may be. And this isn't anything that may be new to you, but ultimately I think it's important to reinforce, just because some of the mechanisms that people are using to manage risk can certainly have embedded additional embedded risk into the long-term compounding success for your clients. And I know we have a poll question. I'll go ahead and get that rolling, Dave, if you want to start conversation here.
Yeah. Actually, as it pertains to your last slide, James, there's an old saying by Larry David, the creator of Seinfeld, and obviously the main character and creator of Curb Your Enthusiasm. But he has a quote along the lines of like, I'd rather have thieves than neighbors, because thieves just want your things. Neighbors want your time. I'll give up my things. I'm not going to give up my time. And a lot of the conversation that we're going to have alongside today is going to talk about longevity risk. And when longevity risk happens, it's a difficult conversation you have to have with your clients, because they have not compounded capital at the level sufficient to meet their retirement goals. But they're in a very difficult position because they have no more time. So I think that's why that commentary is so funny. I'd rather have thieves than neighbors, because I don't want to give up my time, because we know in investing, having a longer time horizon definitely allows your portfolio, one, to take on more risk and take on more volatility. But if you stay the course, obviously you're going to have more fruitful results than someone that tries to time the market itself. But that brings us to our first poll question here. And I'd love some participation from people. James, you can probably even participate yourself. But what asset class between these two do you have a more favorable outlook over the next year? Do you have a more favorable outlook for stocks, or do you have a more favorable outlook for bonds? So I'll give everyone a few moments to put in their answer, and we'll probably play with these results throughout the entire presentation and coincide them with some things that we think people need to be focusing on the asset allocation side.
Well, we didn't have too many participants, but we did have 50% in stocks and 50% in bonds as far as the responses go.
Let me just talk to like those responses there too, because I think if you ask most people, given where valuations and where nominal yields are, I think that a lot of people are going to say fixed income right now. A lot, James, to the point that you made before, like, hey, I could get a CD or a money market at 5%. I'd rather take that over the fact, the Barclays Ag's down like 87 basis points as of quarter end. So I'm actually really happy to see people actually say stocks in this type of environment right now. I understand that a lot of people are not gung-ho on stocks because of current valuation levels. The S&P 500's forward return is closer to 20 times, and putting it in its like top 90th percentile versus its history. So I actually am, because if I had to choose an answer, I would actually say stocks, and I'll explain why throughout this entire presentation. But it's good to see some people actually on that side. Now, I'm not saying one side's right and one side's wrong. I'm just saying where I'd probably put a little bit more of my marbles within an asset allocation. But one, thanks so much for having me back, y'all. I think this is my third or fourth time speaking here at the Georgia FPA. I've done a few market commentaries, market outlooks, a few things regarding midterm elections and its ramifications on markets. So this is going to be my first time talking about the structure of an asset allocation, on why having a proper structure in place and how that mitigates drawdown risk and longevity risk is probably one of the most important topics that I can talk about, well more important than anything regarding the market and the potential direction of where it could be handling it. But as y'all know, before every talk, I kind of give a disclaimer. I could be a little bit of a wild card. I apologize if I say something that someone doesn't like from an investment standpoint, but the good thing about me is you're going to get raw me on what I think about the market and what I think about issues, because I do have a lot of conviction at the market level, at the economic level, but even more so at the structure of an allocation level. And as we start every single conversation, actually, with Georgia FPA and Aptis, we try to bring things back home. we try to be very simplistic in everything that we speak about, because the more palatable that you can be from a conversational standpoint between us and you can then transition a lot of that commentary to your clients. And this is one thing that has caught a lot of people, has benefited a lot of people by breaking down the market as a whole. And this is a slide that we show. It's how are returns generated? And simplistically speaking, we know that returns are generated through three different sources. The first one's going to be yield. The second is going to be some type of growth metric, tends to be earnings growth. And the third metric is going to be a valuation expansion or contraction. And whatever decade you look at, and this is all measured by the S&P 500, by the way, you can break returns down into those three factors. You can trifurcate it between yield, growth, and valuation expansion or contraction. And when you look at over longer periods of time, longer periods of history, dividend yield tends to contribute about 35% to total long-term returns. Earnings growth, well, it tends to be about 60%, all right, contributory to long-term returns. And given recency bias of quantitative easing and the expansion of valuations well above historical levels, I think this third part may surprise people, that valuation expansion or contraction really only contributes about 5 to 7% over longer periods of time. And I'll tell you that a lot of that contributory number has actually come from more recent decades. And for many of the people that heard me speak at Georgia FP, I think it was back in February, I spoke about one of our highest conviction ideas is that we believe this is going to be the year of the yield. It might even be more plural than singular, that we may be years or decade of the yield. And it really comes down to this chart whatsoever, because right now, we think that taking the bird in hand of yield through stocks, not necessarily fixed income, is sometimes better than taking the two in the bush of earnings growth and valuation expansion or contraction. Because if you look at earnings growth for 2023, it's coming in at a pretty paltry number of about 2%. Historically, on average, the average earnings growth for the S&P 500 tends to be about 7 or 8%. If you actually look at earnings growth from this year to 2024, you're getting closer to an 11% on a bottoms-up analysis and about an 8% on a top-down analysis. So the market is expecting some type of earnings growth to come back to the market in 2024. At the end of the call, I can answer questions on if we believe that's a feasible number or not. But the biggest thing to take away here is that valuation change is immaterial, in my opinion, and per these numbers, to returns over longer periods of time. So at the asset allocation level, how can I focus on, one, getting more yield, and two, focusing on aspects and asset classes that actually have some type of growth, while not relying on valuation expansion or contraction? Because valuation expansion and contraction, in a nutshell, is just basically a investor sentiment on the market. Are they bullish or bearish? If they're bullish, they're going to be willing to pay a higher valuation. If they're bearish, they're probably not going to be as susceptible as paying the current valuation right now. But how can we create and structure a portfolio that focuses on yield and actual growth? And before we go to the next slide, I'm going to focus on the growth part here, because it's obviously, when it comes to yield, you get yield from bonds, but you can also get yield from stocks. But the growth aspect of the portfolio, at least moving forward, I would rather have, over longer periods of time, stocks tend to have a higher growth rate than fixed income. Fixed income currently has a nominal yield about 5% right now, a real rate closer to 2%. We'll touch base on that here in a second. But as I mentioned, earnings growth over longer periods of time has had an average annualized growth rate of about 8%, much higher than what we're getting in fixed income itself. So what we try to do with the structure of a lot of our allocations is let's tilt and put more allocation into areas of the market that we believe have actual return drivers moving forward, and that's going to be stocks. But the first question when I state that, normally people are like, well, if you have more ownership or an allocation in stocks, well, you're probably taking on more risk. Well, we would come back and state that we have a way that I think is pretty innovative to own more stocks, less bonds, but do it at risk neutral levels. All right, so we can still take in yield, we can still enhance our yield, but we can have more of an allocation to growth through stocks and bonds, but being risk neutral. So obviously today's conversation is correlation risk and diversifiers, all right? And as I started off, can you go to the next slide, James? As I started off, talking about back on that short-term certainty versus long-term awareness of long-term returns, it's been a very difficult year for a lot of advisors out there, because what worked last year definitely didn't work this year. The conviction from last year did not translate into this year. So by numbers of having the iShares, BlackRock benchmarks outperforming basically 95% of allocators, a lot of people right now are having difficult problems, all right? Because they're having tough conversations with clients because they're underperforming right now. So at Aptus, we have clients and partners throughout the entire country. So we have a great ear to the ground on what people are saying in that regard and how they're handling that conversation. And that's obviously something that I can bring on up. But we would speak with these advisors. I was asking, like, what's your biggest problem right now with the market, the economy, or your asset allocation? And a lot of people go, hey, you know what? We just don't see a whole lot of great prospects for fixed income right now. Better than where it was 10 years ago, but also on the stock side, we're not too hepped up on stocks. But more importantly, we're underperforming right now. Like, how do we create an asset allocation that can do well if fixed income performs well, if equities perform well, or if we get a right tail risk or left tail risk? Because I think the biggest thing that advisors and asset allocators have learned this year and actually last year is that fixed income, hasn't really been the insulative support that it has historically been over the last 20, 30 years. If you go back just to recency bias of 2022, like S&P 500 was down 18%, and the U.S. Barclays Ag was closer to down 13%, meaning that they were positively correlated. But that just hasn't been a one-year phenomena. It's actually started to occur this year itself. Ever since the July, S&P 500 is basically down 6%, and the Barclays Ag is down 3%. So you still remain positively correlated. So a lot of the conversations, though, that I'm surrounding having clients right now and a lot of our partners is the differentiation between the structure of your asset allocation is one, and then your exposures and tilts, all right? And a lot of the conversations that we're having right now, given the change in what worked last year from this year, everyone's talking about exposures, the tilts that they have right now. And I think that's kind of the wrong way of looking at it. I could care less about my exposures and tilts. Like, are we overweight value, overweight growth, overweight duration, underweight duration, overweight small? I could care less, because if you have a risk managed solution where you can still make slight bets on tilts, but not let it affect your overall return stream because you have the right structure in place, that's how you can work in a situation from last year and this year. So talking about what I would believe and consider to be some of the biggest risks at the asset allocation level are two different risks. I'd actually could maybe throw a third one in here I've been thinking about, but the first one's going to be drawdown risk. Drawdown risk is very, very simple. Right? When drawdowns happen, it hits clients and investors in the face. When drawdowns occur, they occur. Go back to February 19th of 2020 to March 23rd of 2020. Everyone knew about that drawdown risk. The S&P 500 was down peak to trough of almost 34%. Drawdown risk hits you square in the face, and you know exactly when it happens. Drawdown risk basically is an interruption, a period of time where it interrupts your ability to compound capital and triggers fear from a client's perspective. All right. But the second risk is, I think, one of my most scary risks right now that I'm seeing out there in the market, because longevity risk is not like drawdown risk, right? Drawdown risk, like I said, it slaps you square in the face when it occurs. Longevity risk, it hits you square across the face, not now, years down the road, but it happens at a time where you don't have as much time to recoup the damages, to a point where you have to have very difficult conversations with your clients of, hey, you have to work longer, or two, you have to work less. Basically a change in their behavior. Longevity risk, if it's silently injected into your portfolio, it makes you have to have a very difficult conversation with your clients because it has to change their behavior. All right, you can make up ground if you have drawdown risk, okay? But when longevity risk occurs and happens to a client's portfolio, that's when you have the difficult conversations that probably leave you quite exposed to getting fired, all right? And before we go to the next slide, like, I can focus on these two risks and tell you what they are, but I think one of the most important things we can take away from this presentation is, like, what levers do you advisors have at your fingertips to try to mitigate drawdown risk, to try to mitigate longevity risk? And that's what we'll touch base on here in a second.
Obviously, longevity risk is something maybe that's been a little bit more common in conversations here the last couple of years, given higher inflation numbers. Longevity risk can be inadequate returns. It can be expenses rising where that there's impact to the income numbers later on in retirement. And ultimately there's a number of really good analysis as it relates to the impact of inflation and variable inflation on the ability for a retiree to be successful. And so I'll get into that a little bit later, but just wanted to touch on that. So this is a slide that we've used in prior presentations with the Georgia FPA. So maybe we'll have better, more accurate results as far as if you're familiar with this question. But we have a list of 4 different portfolios and 5 different years of returns. You can see the average return here on the right side, the right column. And ultimately, the question is, which portfolio would you want to own given the return stream? And it's not necessarily what fits your risk tolerance. It's what portfolio is going to compound the most at the end of this 5-year period. And I'll launch this.
And we're giving you the answer here, and actually in that right column, if you think about it, we're giving you the average return of those 5 periods. So maybe we're giving you a cheat code here.
Let's give it a minute here.
So we just brought up a poll question here. So which portfolio do you want to own? Portfolio A, B, C, or D?
All right. So the choice from the bulk of the population is C, which is interesting. D usually is the answer. Yeah, D is usually the answer we see. The right answer is actually B. And the biggest thing I'll mention here, and I'll let Dave expand on it. You can see the average portfolio returns, which we of course gave you on the last slide, and the compounded returns right next to it. And the interesting thing here in what we call the volatility tax is the difference between the average and compound returns. And portfolio B has the least amount of difference between the two numbers. And at the end of the 5-year period, the best outcome.
So stay on this slide for a second. Why did we ask y'all to look at these 4 portfolios to see which one did better? Well, go back to what my 2 biggest risks are at the asset allocation. It's going to be drawdown risk and longevity risk. This is a great conceptual example of why drawdown risk is so important, to make sure that you can protect capital on the downside, all right? Because that can get you from point A to point B in a smoother and quicker fashion, okay? Because just mathematically speaking, all right, well, portfolio B, it was, probably had the smallest variation of returns. But portfolio D started off down 30, all right? And it took so much for that portfolio to come back. Even with portfolio C, you started off on the right foot, being up 21%, but year 3 and year 4 really derailed you from protecting capital. So this is, from a math perspective, it works, because if you draw down 50%, you need to mathematically return 100% to get back to even. And so this is actually somewhat of a new phenomenon out there. It's called the sequencing of returns. And that's kind of what James just mentioned there. And if we have a lot more white papers expanding on this topic, so if you would like to see that, just shoot us a message. But it really shows you the importance of, minimizing your variability on an annual basis from your return stream, all right, because that will get you from point A to point B in a more smooth fashion. So basically said another way, if you can minimize the difference between your average and compounded return, that's what we consider and call our equity volatility tax, you're better off.
And this just kind of expands on the volatility tax, just with, thinking about a good example would be last year to this year. But if you draw down 40%, don't need 40% to get to neutral. It's actually 66.7%. It's a common misconception, not necessarily among advisors, but certainly with clients. And
but I even think that third column is even more important. If you have a 8% net CAGR afterwards, just how many years it actually takes for you to recover that lost capital. I mean, when you draw down 40%, you need, like you said, James, you need 67% to recover. And that on average, at an 8% net CAGR, takes over 6.5 years. And when time is of the essence, especially for a lot of your clients who try to compound capital to get to their retirement goals, whatever it so may be, like that's a very important figure. And that's why drawdown risk, mitigating drawdown risk is so important at the portfolio level to make sure you can help your clients ascertain their long-term goals.
Yeah. And I won't do this last poll. We'll just go ahead and get right into it. But thinking about everything that's worked this year versus what worked last year, and the differences in the different sectors and indexes, as far as the performance, I would probably, if I was in a cave, say that growth has compounded the most from 2022 to the beginning of 22 to today. But that obviously doesn't go into what we're talking about as it relates to the volatility tax. And this slide hopefully illustrates that, with value actually being the leader in the clubhouse among a number of different benchmarks that you guys are invested in some form or fashion.
But the thing is, like, when you have conversations with clients, like, they're mad that you're not overweight growth. But if you go into the beginning of this year, like, what did everyone want? Everyone wanted to own value. Everyone wanted to own dividend stocks. Everyone wanted to own small caps. And unless you flip the switch right on December 31st of 2022, like, to growth, to exactly what everyone hated last year, like, you're underperforming. But this is a great real life example that we're seeing and speaking with our clients about, like, showing the importance of drawdown risk, showing the importance of the equity volatility tax, on how it can this is the most important part, how it can derail a client from their long-term goals. Because when you see these types of returns, what behavior does that inject? All right. Well, people want to chase. People chased into value last year, and now they're chasing back into growth. And if you have the right structure, this is like where we're going to like bring everything together here. If you have the right structure where you can just let your stocks be stocks, like, you don't have to make these bets. That goes back to my point, like focusing on your exposure and focusing on your tilts. Everyone's focusing on their tilts right now, not their structure. All right. And when you're underperforming and you think that your investment acumen is being better than your peers by choosing an investment style, growth, value, small, like, you're in a losing battle. Because when you do that, you have to be right twice, when you buy and when you sell. All right. So you're injecting timing risk into your portfolio. And the best analogy that I tell people with that is, well, one, there's so many people out there, no offense, even better than myself, that can make these decisions more consistently. But when you trade more and try to trade in and out of these styles, these factors, right? It's like you're in your kitchen preparing a pie crust. The more you play around with that pie crust, the worse off it is. So sometimes at the asset allocation level, as sexy it is to talk about, oh, we're overweight value, small caps, like, sometimes it's just better to let your stocks be stocks and own the S&P 500, because that's what every one of our clients benchmark themselves off of. Because if you turn on CNBC, Bloomberg, MSNBC, like, what returns are they seeing? They're seeing the S&P 500. So why not be the S&P 500 so you can mitigate the risk of choosing the wrong tilts? Because if you choose the wrong tilts, all right, and your clients see that, you choose it wrong twice, that's how you have client retention issues, all right? Because you were wrong by not owning it in the first place. And then you double down on owning something else that used to perform and it started to underperform. So you've been double whacked in a way. And that's why I think you just got to let your stocks be stocks.
It kind of relates to our services as far as what we're trying to do with our advisor partners and just building a structure and maintaining that structure. We're not saying that you're going to always be exactly in line with your benchmarks, with your international exposure, your bond duration, whatever the case is. It's much more understanding what your benchmark is, number one, because a lot of advisors don't even have a real life benchmark. And two, understanding the amount of attribution risk that you're willing to take when it comes to some of these factor bets. But yes, he's spot on. Dave's spot on when he's talking about the timing risk. You think about timing risk with like trend or with going 15% in cash, but the timing risk connects to these different tilts as well, without question. And last year was a great example of the challenges that we can have with correlation risk, given that the 60-40 was down so much, with the 40 being down just almost as much as the 60. And sequence of returns risk is something that should be on everybody's radar that's working with retirees. It's something that you can't ever discount when it comes to thinking about the long-term outcomes for your retirees. And when it comes to just, okay, let's break it down to a real life example. From 2000 to 2005, we have the returns outlined, and the retirees getting $50,000 a year, which is inflated at 2% per year. And you see the ending balance here after that period. And let's just reverse those returns and see how much different the scenario is. And so the earlier on in your retirement and within your portfolio construction, some of these tilts and timing aspects can be more and more emphasized with your clients' financial planning success. And just wanted to be sure that we highlighted this. Drawdown risk is something that slaps us in the face, and it definitely will slap you in the face if you're in your retirement years. We've kind of hit on this quite a bit already. Dave, do you have anything you want to expand here?
I do, and I think this is a misnomer in the market. It's actually one of my biggest risks out there short term, because I told you my long-term risk, the asset allocation or drawdown risk, and longevity risk. But I think like the short-term factor that right now that can lead to longevity risk in the portfolio, and you might want to go to the next slide, James. I forget what I have next, but I think it might be a little bit helpful. Okay, yeah, we'll stick here. So two things. Everyone right now, like as I think of the poll question we put out at the beginning, 50% of the people wanted to be probably more overweight fixed income. All right. Hey, their conviction is we haven't seen rates like this since 2007. We would love just to click 5%. That's something we're just not accustomed to. We're not used to. Some of our client base is older in life. Well, here's my biggest risk to that. All right. Because I actually am a firm believer of being overweight stocks and underweight fixed income. People think in terms of nominal. All right, but they eat real returns. Let's break that sentence down. Nominal returns are basically your returns without considering inflation. Real returns is your nominal rate of return minus inflation. So it takes in consideration of inflation. But people think in terms of 5%. If you get a 5% wage bump, if you have a CD or money market, bringing in 5% more income, what are you going to probably do? You're probably going to increase your spending by 5%. But they eat real returns. So they might be spending 5% more, but they are actually owning 2% right now on a real basis. And if you continue to do that over longer periods of time, you're just eating away at your ability to compound capital, obviously, but it also injects longevity risk because you're spending more than what your plan states you should be spending, meaning that your retirement goal way down the road may have to be pushed out longer, or you may have to spend less, because you've been spending too much now because you think in terms of I'm getting 5%, even though you're eating the real returns of 2%. And when it comes down to like the overall arching theme of this presentation, what's the difference between, risk mitigators and diversifiers? A lot of people, and I mentioned this before, aren't recognizing that there's a positive correlation between stocks and bonds right now, right? And if you actually take this image, and I would ask Is there more of a highlighted portion above the Mendoza line of zero or below the Mendoza line of zero? And people are going to come back and be like, well, it's above. And what this chart is showing you, it's the highlighted parts. When it's above zero, that means stocks and bonds have a positive correlation. That means when stocks go up, bonds go up. When stocks go down, bonds go down. All right. But recency bias, basically ever since the initiation of globalization and some type of quantitative easing metrics, you've seen an inverse correlation between fixed income and stocks. And what schools teach you, what recency biases teach you, probably state that, hey, you know what? That inverse correlation is going to continue into the future. And that's how I'm going to build my plans at the asset allocation level. I'm going to have, hey, you know what? Stocks are going to be my insulating factor. All right. And you're seeing this in retail behavior still to this day. Right now, TLT, which is basically an ETF, pardon me, that measures basically 20-year treasury bonds. You've seen just last month a record amounts of flows into TLT, a 20-year, it's actually like a 17.5-year duration. Okay, so people are expecting that bonds, if there's some type of recession or some type of volatility in the market, Fed's going to cut, rates are going to come down, and those are going to be the insulating factors, all right, being the yin to the yang of stocks. But if you actually have some type of situation where bond correlation and stock correlation are positive, what happens to your portfolio if that pertains, or if that goes on much longer than what one would anticipate? Because again, if you look at this chart, actually seeing an inverse correlation is more unlikely. All right, seeing a positive correlation tends to happen more often. So what if we get back to that regime again? And I think that's why the structure of the allocation is so important, because you can't utilize duration, i.e. fixed income, to be that insulating factor in a portfolio to mitigate one of my biggest risks at the asset allocation, which is drawdown risk, okay? Because if bonds go down a ton, much like they do in stocks, that's what creates drawdown risk at the portfolio. And so we've laid out all these different problems we see at the asset allocation. And I think that's one of the biggest difficulties in our industries. Hey, we know what the problems are, but we are so ingrained in the, what I would consider the antiquated 60-40 portfolio, that we don't know what levers that we have to pull to mitigate these risks. All right, if you ask any of my analysts or some of the portfolio managers, always say this quote: the most difficult way to get new ideas into your head is to get the old ideas out. All right. And I do think that the antiquated way of a 60-40 portfolio is an old idea that needs to get moved out of the brain so these new ideas can filter in. And that's why this slide is awesome. I love this slide. The importance of the allocation structure, because everything I've talked about today, it's like, hey, we can focus on our tilts or we can focus on our structure. And this is a scientific study or financial study that shows that, hey, you know what? Over longer periods of time, investment outcomes are largely determined by the long-term mixture of assets in a portfolio. So that's saying security selection and market timing. The exposures aspect only contributes 8.9% to total return over longer periods of time. But the asset allocation, having the right structure in place, actually contributes 91.1% to total return over longer period of time. Yet everyone spends all their time on the top one, security selection and funds. All right, but not the bottom one. So what do I mean by this? Like, what do I mean by the structure of the asset allocation? And let's use an analogy. And we're in the MLB postseason, and I know everyone over there in Atlanta is having a much better time than what I am here in Cincinnati because my Reds are not in the postseason. But if you look at a baseball lineup, a 9-man baseball lineup, you're not going to want every single one of your hitters to be home run hitters. You're not going to want every one of your batters to be defensive players. You're not going to want them to be, singles hitters. You want an amalgamation, a mixture of some home run hitters, some hitters that do well versus lefties, some hitters that do well versus righties, and you probably want some great defensive type of oriented players in your batting lineup. Like your home run hitters for Atlanta would be Olsen, 54 home runs this year. You know what you're going to get out of him. If you want an all-star guy that can do it all, hit versus lefties and righties, you're going against Ronald Acuna Jr. If you want more of the defender, that has a better defensive standpoint, you could look at, Michael Harris, your center fielder. All right. Obviously, maybe the Braves aren't the best analogy because you guys are probably one of the most well-rounded rosters since my 75 and 76 Cincinnati Reds. But the analogy holds true. You're going to have some batters in the lineup that may be hitting 200 batting average. All right. But you keep them in the lineup because their defensive prowess at shortstop, at center field, behind the plate, All right. So like, that's just a great analogy on understanding the benefits of diversification. And that's what we're talking about at the structural level. So if we go to the next slide, like how do we think about the proper structure at an asset allocation level to make sure our baseball, our batting lineup is ready for any type of environment? Because I want to have an allocation that does well versus righties, right-handed pitchers, left-handed pitchers, or in market terms versus right tail events when equities rip and run higher, or in left tail events when markets rip lower. I want to be able to do both in all environments. And that's how you mitigate longevity risk, because you're minimizing the volatility of your return stream. And we do that here at Aptus by owning more stocks, less bonds. And one would think that's inherently more risk because you're owning more stocks, less bonds, but we do it in a way that's risk neutral. And most people come to like, well, how do you do that in a way that's risk neutral? Well, we utilize something, many of you probably heard us talk about it. We believe we want to utilize volatility as an asset class. All right. And most people go, well, what's volatility? How do you incorporate volatility as an asset class in your portfolio? Because it may sound backwards, but by owning volatility as an asset class, as a sliver in your portfolio, it actually minimizes the volatility of return streams in the future. Okay. But what is volatility as an asset class? I'm not a huge proponent, believer. I love this analogy, but it's not the best analogy. But, let's think of volatility as an asset class as like paying a premium on your insurance. All right. Everyone has insurance on their home. They pay a premium every single year. Hopefully they've never had to utilize it. People, to be able to drive on the U.S. roadways, you have to have insurance on your car. They pay a premium on their car. Hopefully they don't have to utilize it, but they still pay it. All right. That's when you basically have this negative carry. All right. You pay something out that you're expecting probably not to get back. I mean, when you're creating your budget every single year, you're not like, all right, hey, you know what? I'm not going to pay my insurance anymore. I've never had to use it. I've never, I'm wasting $500 a year on premium for my XYZ car. I'm going to stop paying it. No one ever does that because they know the potential ramification it can have if you get that left tail event of a car accident, of a house fire. All right. But apparently no one owns insurance on their largest financial nest egg, which is probably going to be their financial assets. No one owns insurance on them. So basically owning volatility as an asset class, it may just be part of a sliver of your overall asset allocation. It's basically you paying a premium that you're getting this negative carry because right now, as I just mentioned, there's a positive correlation between fixed income and stocks. That's giving you a positive carry because you still create some type of correlation risk out there. All right. But if you have this negative carry vehicle and owning volatility as an asset class, you're owning some type of inefficient active ETF format, I might add, long puts on the market. That right there, it's going to be a negative carry if the market goes up, but you should be able to outperform. For a fact, given the financial vehicle itself, that when the market goes down, a long put on that market, that value is going to go up. So that's what we mean as volatility as an asset class. So how can I efficiently inject volatility as an asset class into the portfolio? But more importantly, by doing so, what does it do to an asset allocation? All right. I know that I'm holding this negative carry vehicle where I'm paying a premium where I don't have to use it. Is that negating my benefit to the upside by the amount that I'm paying on that negative carry? And I would say no. I would say no, it won't. If you structure your asset allocation properly, of owning more stocks, all right, owning more areas of the market that we believe have long-term return drivers and less fixed income, but being risk neutral. And I hate to bring stats up into this conversation. I do want to be this is a big point. I'm going to be a little bit quicker because we are running out on time. But I hate to bring stats. This is a normal bell curve, okay? And if you go back to stats 101, a one standard deviation is 68%. All right, that means that 68% of the chance you're going to be within one standard deviation distribution, okay? But if you're outside of that, let's consider that your left tail and right tail exposure in the market. So there you go. So if I own more stocks, less bonds, okay? And that's the right tail risk. You do 1 minus 68%, which is one standard deviation. But since you're breaking them out in two, you're bifurcating them between right tail risk and left tail risk. You have to 1 minus 68 is 32, but divide that by 2. So hypothetically speaking, in a normal market environment, the right tail should happen 16% of the time. The left tail should also happen 16% of the time, okay? But if you own more stocks, less bonds, all right, you can do well in the right tail aspect of the market. If you harness volatility as an asset class, paying that premium on your insurance to make sure you're protected on the downside, all right, you can do better on the left tail risk, okay? And this middle zone, the 68%, that's your safe zone. You're never going to be in trouble with your clients if you are just collecting dividends, collecting interest, and there's not a whole lot of volatility in the market. Those are easy conversations with your clients. The difficult conversations that you have with your clients are during those periods of time when you're owning, the right tail or the left tail, and you're underperforming. Because what's the worst conversation you can have? Like, if you don't participate on the upside at an asset allocation level and you have full capture on the downside, that's how you inject client retention problems. That's when clients leave you. All right. So if you could do better in these tails when the market goes up and do better when the market goes down, mitigating drawdown risk, that's how you create a portfolio that utilizes sequencing of returns to its benefit to compound capital, minimizing that volatility tax we just spoke about earlier, to make sure you get from point A to point B. They may not be sexy returns, but they're going to be less volatile returns, so you can get to point B much faster, but more importantly, with less behavior risk of your client trying to time the market because they think something bad is going to happen. Okay. So if you go to the next slide, I always like to show the proof is in the pudding, because I can give you my investment methodology from a qualitative standpoint, but you have to look at it from a numerical standpoint also. And what this blue line is showing, it's the growth of $100,000 from January 1st, 2000 to August 31st, 2022. The blue line is showing if you had 100% capture of the S&P 500, that's 100% on the upside and 100% on the downside. Okay. And that would yield you a return of about 500% to $500,000 from your initial investment of 100,000. But if you create some type of asymmetry here, all right, where you capture 80% of the upside while 60% of the downside, you can compound capital at a much better rate of return. All right. And this is just over the last 22 years. You're almost having an 80% higher, 75% higher return over that 23-year period. And if you go back to the previous slide, James, like setting expectation, this is a lot of what we do at Aptus, at our structure of our allocation. All right. Like, what do you expect your allocation to do in certain environments? Well, on relative to a benchmark, all right, relative to an iShares benchmark, I want the structure of the Aptus allocation to capture 105 to 110% of the upside versus the benchmark. But on the downside, I want to capture closer to 90 to 95% of the market or benchmark's downturn. And that's the asymmetry that you want. Like, asymmetry is the crown jewel in the investment world. Howard Marks talks about it all the time. If you can find a manager that has the ability to give you asymmetry on a consistent basis, and that's while keeping risk in check, all right, and that's important. Asymmetry, consistent asymmetry, all right, with lower volatility, that's the manager that you want, because they're going to be more successful over longer periods of time, all right, because they're tilting the odds in your favor to succeed. And by harnessing volatility as an asset class on the drawdown side and owning more stocks, less bonds, by putting more of an allocation in your return driver of something that we believe, has a return driver, that's how you create asymmetry. And that's how I expect our asset allocations to perform over a full market cycle. And Yehudi, if you go back down to that bottom slide, if you create asymmetry, what our asset allocations are trying to do, that can help you. And I know this is showing the S&P 500, but this is giving you an example of how asymmetry can work for you over longer periods of time, capturing more of the upside and capturing less of the downside. All right, that's the asymmetry we want. And so this next slide that we go to, is kind of our output. Pardon me, James?
Yeah, one just comment I'll add to the equation, just because we have exposure to a number of different independent advisors' practices and what they're considering, since we do regular investment committee calls with them. The behavioral risks that we often talk about with clients and selling or timing things is certainly been a common occurrence among advisors. Not saying that our advisors that we work with don't know what they're doing, but it's a common conversation this year, last year, to consider making these factor tilts or adding duration, or right now everybody's trying to reduce duration after what happened in September. So these behavioral risks are out there, and it it can lead to bad outcomes. Hopefully not for you, but just something very important to discuss. And the output that we have here is hopefully the proof in the pudding, just as it relates to the risk associated with our portfolio that includes volatility as an asset class. You can see that we actually have 10%, 10% more in equity exposure with a similar, if not even lower risk number, according to nitrogen's output. And it's not saying that we have less risk in our eyes, because this is the risk number is arbitrary, but ultimately it's saying that we have a similar risk with almost 10% more in equities in our portfolios.
And we're going to close up here pretty soon. And one, if you have any questions, please ask or reach out to us. But the call to action here is, are you doing enough? Are you cognizant enough of what you're doing when you comprise your asset allocation at the structure level to make sure that you're mitigating longevity risk? Because like I mentioned before, longevity risk is the worst possible situation for a client to come in, because once you recognize that longevity risk has been silently injected into your portfolio, one, you're probably not going to retain that client, but two, that client's not going to have enough time to recapture the losses from that longevity risk without changing their lifestyle. And that's the worst thing you want from a client, is that your I forget what that simulation is, didn't work, right? You needed 5% to compound capital over longer periods of time to make sure they got to the retirement goal, but they only did it at 4 or 3. So they have to work longer or change their amount of spending. And I think that a lot of people, and we know asset allocations, the structured allocations really well, don't know a lot of the hidden risks, because that's what longevity is. It's a silent risk, the hidden risk at their asset allocation level. And what we do for a lot of our partners is a lot of people send over their allocations, and we can kind of try to pinpoint where we think longevity risk is really hiding at an asset allocation level. That is our strong suit. That's our bailiwick, is portfolio construction at the asset allocation side.
Focus on the asset allocation first and foremost in the structure versus the underlying exposures, without question. There are some additional resources here. Our charts of the week is a part of our blog, which is a popular Friday once a week output that we put out, and our content hub has a number of research reports on individual securities, on just asset allocation, write-ups, whatever the case may be. So feel free to use these QR codes and reach out to our team anytime with questions, or if you want to dig more into what we're talking about today, we'd love to. I know we're at the end of our time, so just wanted to thank everybody for coming out. Thanks to FBA for including us, and hope everybody has a great day. And hopefully the Texas Rangers will be seeing the Braves here in a few weeks.
I knew it was coming.
Thanks, gentlemen, so much for this very informative presentation.
Thanks,
and
Kathy.
thanks to everyone. Thank you. And thanks to everyone who connected with us today. Please look for an event survey replay in the presentation to follow. Thanks so much. Have a great afternoon. Go Braves.
Bless y'all.
Thank you.
Bye-bye.